Okay, so all right, so let's look at our stock market calendar for today. Um, we're coming we're coming up to the best months seasonally of the year. October, November, December, and January are some of the best months. If we look at our history of returns for the last 20 years, 30 years, 40 years, you can see the October, November, December. There's this seasonality that help stocks. There's pensions that need funded, end of year window dressing, all kind of things going on we don't know about. And also in October we have just positionings of ETFs, and there's all kind of quarterly things that happen, and earnings come out in October. So we have seasonality on our side. We knew that from the beginning of the year. And okay, so right now we're at November. Okay, we had an FOMC statement. The Federal Reserve made a statement on Wednesday, and and that was very good for the stock market. Is what's happening right now. We've been in an upward cycle for rates for almost a year or two right now, and it wasn't until this meeting that the Federal Reserve said we're basically seeing signs that we don't need to raise interest rates anymore. And the reason why that's so important is that is really good for the stock market, because interest rates are in a direct correlation, inverse correlation to the stocks. Let's look at some of the charts here. Hold on for a second, this is worth it. Here, it's right here. Okay, the 10-year and the 2-year Treasury. So basically what the 10-year and the 2-year Treasury, these are almost guaranteed investments. If you put your money into a 10-year Treasury, there's a 99.99999% chance you're going to get your return if you wait 10 years. And what happens is, after that Fed statement, the yields for these 10-year Treasuries are going down. So what's happening is we're at a peak of interest rates around right now. So if anyone here is interested in getting a fixed bond or a CD or anything that's secure, that's a fixed income like thing, jump at it now and start dollar costing now, because this is probably the highest CD rates you're going to get. So you can see the rates. We have two things here, the graph. One is the 10-year Treasury rate. And you can see in the past week, it just jumped off a cliff. It went down from 5 to 4.5, and that's a lot. And the same thing with the 2-year, it's going down. So it's whenever the treasury rates go down, the stocks go up. So that's why the stock market is going up for the most part right now. Okay, so that's like a big transition. I spent time on it this morning because it's going to be risk on for the stock market as long as people understand interest rates aren't going up anymore. So risk on means we're going to probably have a good rest of the year. So so S&P's been doing good since last week. We had an oversold condition. So let's look at our oversold. Last week we were like right here. It oversold, and we also were at the bottom of the channel. And we had a choice of continuing this downward channel where you have higher highs, lower lows, or we can continue this upward channel where we continue to make higher highs. So last Friday was like a super decision point, and we were oversold. So that when it's oversold and you're not invested at all, that's the time to start dollar costing or buying a little bit at a time into the stock market into what you want to buy. And so it very reliably bounced off of that. And you can see that today we might be going out of this downtrend, little side downtrend thing here. And that means we probably will go up to here in that in our channel. Now these channels I make here, I'm drawing these lines. They're not like 100% accurate. but there are enough people following these, draw the lows on all the graphs and on the highs, and there's enough people following that where it ends up being true. That's the only way I can explain it. Or there's algorithms that keep track of this and automatically buy and sell whenever it gets to the top of these channels. I don't know. But it seems to be working. So let's stick with that. So earnings have been pretty good this earnings season. There hasn't been many really bad surprises, especially for the big tech stocks. Apple just reported this week, and they're basically not growing for the past year. Their earnings haven't been growing, so they're kind of stagnant, and so they're probably going to be going sideways for the rest of the year, because they're not really showing a whole lot of growth. Let me see. We're starting to gain momentum in the stock market again. So last week we had 14% of the S&P above the 50-day moving average. Now it's 40%. So it was the 200-day moving average. S&P companies above the 200-day was 27. Now it's 38. So we might start to be building momentum again in the stock market. So that's good. And you see. All right, those are our talking points. Let me see. We talked about seasonality. Right now is a good time. Stochastics right now, we're at 51, and that's halfway between overbought and oversold. So that's like right in the middle. So it could go up or down right now, but it's not a super oversold, not super overbought, just right in the middle. And let me see. We haven't had a whole lot of changes in the major variables in the stock market. Oil isn't changing a lot, and inflation's the same. The U.S. dollar is actually going down a little bit. And the U.S. dollar is very important because when U.S. companies sell things overseas, you have, if the dollar goes down, that makes the value of all the money coming in much more. So half of the money coming in for major companies like Apple and Amazon are from overseas. So that's why that's pretty important. Fear and greed, we're actually less fearful than last week. So anytime the stock market goes up, people have less fear. I don't know. That's just the trend. But right now we still have fear in the market. So we're not out of the woods yet. As soon as the stock market starts its end of year, rally, we're going to get greed and extreme greed, and that's going to be dangerous to buy then. Okay, so you can see we're starting a downtrend in the dollar. It's starting to go down in this little downtrend here, and so that means that's good for the stock market, and it has a lot to do with how the jobs are in America and how the U.S. economy is doing. And we had a really, really Goldilocks job report today that came out, and that's really good because the less powerful the jobs market is, the less rates will be rising. So and it had something to do with the auto workers on strike. There's less workers out there. So let's see, the VIX is going down. People are less fearful than before. So it could be all these things are adding up towards the stock market could be rallying towards the end of the year. And so now we're still in fearful mode in the stock market. When we're fearful and capitulation and people are super scared, that's the time you start to look for things to buy. But when people are there's media attention, hey, we're in a bull market, that's the time you have to not buy or just not or sell some if you want to sell anything. Okay, so issues that could lead to a crash. I always monitor some kind of black swan issues. Right now, higher treasury rates is one of the biggest problems that could lead to a crash. We have so much debt in America, and we have to fund that somehow, and we have to get countries to pay for that. And that's still unresolved. That's the biggest thing. We got to keep our eyes on that. Consumer debt is still an issue. Higher gas prices is an issue anymore because they're going down major. So we have more purchasing power for the economy. So that's good for the economy. And you see, the overpriced expensive stocks problem is, the bigger stocks are still expensive, but they have good earnings, and that's making them a little bit less expensive. So our major problems that could cause a crash, they're kind of getting better. So that's why the stock market could be rallying too. And we got to keep in mind we look at this every week. The average PE ratio is around 15 for the S&P 500 when interest rates are 5%, and they're going down. So now we can look at this chart. Whenever the interest rates are going down, it says 4.5. As the interest rates go down, people pay more for the S&P. So after earnings, last week, it was a PE of 19.5. Now the PE ratio is going down as earnings get better. So it's always good to keep this in mind, as if the stock market corrects, we just have to keep in mind the price people are willing to pay for stocks at different interest rates. So, okay. And this is one of the biggest articles that I read that's super important. This Jeffrey Gundlach, he's a billionaire, and he's a super expert at fixed income. He basically said, he confirmed what we've been saying for a long time, that let me show you our calendar first. He's basically saying that we're going to go into a recession at the beginning of this year, and the Fed's going to cut rates like in January. So this is what the whole stock market realized, the bond market realized after Wednesday's meeting. So all this problems about rising interest rates could be over by January. So that's, but he's raising this flag, a problem with the United States debt. He says that it's completely unsustainable, and we could have a financial crisis if we don't do something about the spending too much money in government. And we have to reduce our debt in our 1.7 trillion in deficit spending. So this could be the next black swan we have to watch for. But as long as the interest rates are going down, that will help this problem. So that was like a big thing, because now we're moving away from being afraid of the Fed raising rates to looking at all the companies that they're going back to normal. And I think it's like a risk-on environment now. So people are going to be willing to pay more for stocks because the interest rates are going to go down. So that's really good for anyone investing in the stock market. There was an article on this Fidelity fund manager. He manages a low-price stock fund, and he could pick stocks from anywhere. It's small stocks, medium, or large ones. And he had a couple comments on here I thought were pretty interesting. Let's see. He has annualized total returns of 13%. That's pretty good. That's about what my long-term average is. So they have this system of buying undervalued small and medium-sized company stocks. One of their best stocks of all time, and they said in this article, was Monster Beverage, and he liked their management team, and he liked the idea that they're trying new things. And excuse me, could you hold on for 1 second? It'll be worth it. Hold on. Okay, that was worth it. Let me see. Okay, so what I did, I always like to look at what other fund managers and mutual funds are buying and selling and why they're doing it. And he says you got to keep up with business models actually go away, and you have to keep up with make sure that the company you're invested in is going to be around in 10, 20 years. And he said, if you don't know about the internet, you would have thought that every family would have an encyclopedia or a piano in their house. And today they have neither. So you have to, every company that we're following, that we're investing in, we got to see how they're going to adapt their company to still be profitable and in demand 10, 20 years from now. Okay, so I'm always doing that with the companies I'm researched in, I'm invested in, just to make sure that you're not stuck with a buggy whip manufacturing company, as they say. All right, so he says he likes stocks that are fairly undervalued, not just 10% undervalued. He wants a lot more undervaluation. And I tried to find. I'm going to look at his stocks that he's picking and see if we have any truly undervalued companies. But we see. Okay, it's really. Let me see. He likes to invest in a long view. He doesn't like just five years. He likes 10 years, 20 years down the line. And let me see. So I looked at his stocks that he has in his Fidelity low price stock. And I was surprised to see a lot of large cap companies in here. This United Health, we've been looking at that. What I did was I added the PEG ratio. That's a quick review of how overvalued or undervalued a stock is. And it seems like this stock, United Health, is trading at 1.5 PEG ratio. That is like 1.5 times overvalued. So if you multiply the stock price by 1.5, that's how much it's really should be worth right now. It's the same thing with AutoZone. These are Elvin's Health. It's around fairly valued. The Wells Fargo is the only one that he shows that is a little bit undervalued. So I'm surprised by these, but these are like not very commonly seen in mutual funds. And I couldn't find, I've researched each one, I couldn't find the rationale for his low priced stock. Why would it be low priced? And these are like the only stock that I researched AutoZone. AutoZone is buying back their shares a lot, like maybe 1/3 of their shares are bought back in the last 5 years or 10 years. So whenever you buy back your stock, it reduces the number of shares and it makes you more profitable. Maybe that's why they're doing it. But I couldn't find out why his top 10 are so great. And some of them are overseas. These ones are overseas, so I couldn't even do any research on these ones. Anyways, let's go to the next little topic here. Novo Nordisk, Eli Lilly stocks see boost on obesity drugs. So Eli Lilly came out with their earnings this week, and they said they smashed estimates for their Mounjaro sales. So this product is for diabetes now, but they should get approval for weight loss later this year, and they should get approval for Alzheimer's treatment. So that was interesting to follow that little side story. Let's look at the market movers for today. Stocks that are going up and down the most. Okay, so you can see the breaking news at the top here. Dow jumps 300 points after soft jobs report. So when the jobs aren't as good as expected, it's probably because of the strikes that are happening in the auto sector. There's not as many jobs. So if there's a soft jobs report, that means the Fed isn't going to raise the rates as much. And that's anything that's risk on or tech or high growth stocks. They're going to start going up as interest rates go down. I expected to see all the high tech companies in the top gainers, but no, that's not it. We have Expedia had really good earnings. That's 16%. They want 16%. So, and there's all the companies around travel are going to go up with that. That's kind of in sympathy. So you have Caesars. Let me see. Expedia. Okay, so me see what else is. One's going down the most. We see oil companies. So with that article that Jeffrey Gundlach said, we might be going into recession. That probably means the price of oil goes down, and because as the economy slows and we go into a recession, people use less oil, and the oil demand goes down, and the price goes down. So maybe that is leading everyone to sell their oil holdings, I guess. And the price of oil might be going down today too. You see. Let's look at these sector ETFs. The ones going up and down the most. Okay, the ones. Looks like every sector is going up today. Let's do the index ETFs. That's not giving me what I want. I'm at the wrong page. Hold on. All right, so real estate is going up today. Why would real estate sector be going up the most? If everyone realized this Wednesday that Fed's done raising interest rates and interest rates are going to start going down on January, that means that'll make housing more affordable. People will start buying during the spring housing season, and then everyone will be getting excited about the housing stocks. So maybe that's why real estate is going up today. We have materials for building houses, perhaps. Financials will do better whenever interest rates go down, because they're half of these financials in the sector are in trouble now for having a lot of things on their balance sheets for interest rate sensitive things. So let me see, utilities. As the interest rates go down, the values of these utilities companies are going to go up. That's why I said as of Wednesday of this week, you got to grab your fixed income stuff now, because this is probably one of the highest rates you're going to get for fixed income or high yielding things. So there's a lot of people that have lost money in bond funds and bond oriented things. And right now, even though you're down year to date, this will be the time to start dollar costing into that until January. If you want 10% of your portfolio, for instance, in fixed income, this is probably the highest rates you're going to get for that now. And that's why people are jumping into those kind of sectors. Communication services, consumer discretionary. The ones doing the worst are energy. Let's look at the price of oil today, just because the energy is going down today. It's usually a 1-to-1 correlation to the price of oil. Let's see what the price of oil is. Okay, currencies, cryptos. Oil down 2% today. That's why oil is the worst. I mean, energy is the worst performing sector today. And why is it down? Maybe because of recessionary fears. That's the only thing I can think of right now. All right, that's good to go through that exercise every now and then. All right, so let's look at some charts of interest. We like to go through every once in a well, maybe once a month. We like to go through stochastics just to get some practice in going through some stocks and things we're watching. Just to see if any patterns are. This is one of the one of my favorite things to do. Just to draw a line at the bottom. What I do is I look at the chart of a stock. I try to draw a line that matches the bottoms and the tops of whatever stock you're following, and then you start seeing patterns of the stock is following a new pattern. And whenever you're investing in the stock market, you have to you pick the stocks first based on fundamentals and all these rules that I'm following. And then you got to find when you're going to buy the stock. And the when is one of the hardest things to do, and when to sell is a hard thing to do too. But I try to buy stocks whenever they're at a support channel at the bottom of their channel, and then if I decide to sell it for whatever reason, I want to sell it when it gets to the top of a channel. And you can see that a lot of the major companies, the tech stocks, they basically have grown to a really premium valuation, and people aren't going to keep trees don't grow to the sky. It's the same thing with the stocks. Stocks won't keep going up. They'll reach a point where they're fully valued, and then they kind of tread water for a while until earnings allows them to go up higher. So I'm seeing for a lot of the major stocks like Apple and Microsoft, they're falling into this new pattern, this sideways pattern. And just have to realize the days of going up 40%, they're over, and you're just going to go sideways until you have earnings that are better. Let's look at another one. Meta. This was the best performing stock that we're following this year. It went up like 200 or 300%. And, it's at a point right now where it's kind of fairly valued, and it's also falling into this sideways pattern. It's going sideways. And if you want to buy a stock like this, you wait for it to go to the bottom of this channel, and when you want to sell, you go up to the top of that. So this is just a way to make some sense of when you want to dollar cost into a stock. And it's not always right. And sometimes the news happens, and then the stock drops down to here, and you can just throw all these channels away, and you got to start over again. But for the most part, the stock market, everyone in the stock market that knows anything is making these channels just like me, and you're just trying to time when you get in and get out. And this usually works for stocks that are consistent in their earnings, like Microsoft and Meta and Google. They pretty consistently make their numbers, and you can count on them to regularly follow the same chart patterns too. Okay, let's look at all the stocks we're following. We actually follow every index, or the major indexes for the stock market, and a lot of times stocks actually follow their sector. So if we follow the tech sector, there's a good chance that if the stock is in that tech sector, it's going to follow whatever pattern that this ETF is following. So you can see that we have an S&P right now that's in an uptrend. It's actually still in an uptrend, and it's probably going to, there's a 90% chance, seeing that we have the seasonality here, we're going to be continuing this up, higher highs, higher lows. And it looks like today we probably broke through this little downtrend here. So we don't have to worry about that, hopefully. Let me see. So almost every sector is following the S&P. That's why we look at this S&P as the first thing we look at every week, because the 90% of stocks follow, the main indexes. And the QQQ is very, very similar to the S&P in the formation. So it's going a little bit sideways to down, but it actually broke out of this uptrend. That's the difference. So the QQQ is actually in a sideways to down pattern now. That's interesting. We just started following this defense sector ETF. In this defense sector, I would have thought with all the wars that are starting now in the world that we'd have a pretty high demand for all the defense stocks, but no, it's actually in a downtrend right now. You can see, and That's surprising to me. I'm not sure why that would be, but it's right now it's in the halfway between over. It's like 61, so it's halfway between overbought and oversold. So that's not a buy or a sell for that sector. Gold is in its own world here right now. It's overbought, super overbought at 83. So it's not a time to buy gold if you're interested in gold. Right, the consumer discretionary selector spider. Okay, this is XLY. These are stocks like Procter and Gamble, or stocks that basically people have an option to buy something or not. And a lot of these companies have dividends. So whenever we're looking at this sector, we have to say, well, a high dividend stock, it would be, right now, we're this week, we're changing from being very conservative to pedal on the metal, aggressive, high risk. So this will be in less demand as interest rates go down. Because if interest rates go down, then there could be a demand for the value of dividend-paying stocks goes down. So let's look at the next one, XLV. We're in a sideways pattern here, and that seems like it's pretty intact. It's not changing. Let's look at and we're at the bottom end of that right now. We're at 33. That's oversold, and we're at the bottom of the channel, so that's oversold too. We see XLC. We were in an uptrend all this year, where this is following Microsoft and S&P. We're just basically going sideways now. So you see, healthcare. This is one of the biggest of the sectors we're following. This is in a downtrend. Right now, we're oversold 21, and we're near the bottom, probably halfway, 1/3 between. So it's a good. It's not a good time to buy. It's like halfway between overbought and oversold here. Industrial is in a sideways pattern, and let's see, consumer staples XLP. We're actually started the downtrend. Look, it's been sideways all year long, and all of a sudden, we're seeing it going into a downtrend. So it might next stops might be down here like that. And financials, it's 38, and so this is strange. It's at the top of the channel, yet it's 38, which is oversold. So it's kind of this sector is very, very correlated to the interest rates. So I'm not sure exactly about this sector at all, but I think it would make big moves this week based on the interest rates. Let me see. Utilities. This could be the end of this downtrend for the utilities. If the interest rates go down in January, this will probably break out of this and will start going sideways. This has been in a downtrend for like a year now. But people might want to gravitate towards utilities when you don't have things that yield high interest rates in January. Real estate is another sector. We could be breaking out of this 1-year downtrend today because of the realization everyone has that interest rates are peaking. So I'm not a big fixed income investor or anything like that, so I don't know a whole lot about utilities. The XLE, it looks like it's in an uptrend, but it's going down in a major way, and it's oversold now. Let's see. This Brazil, all right, and this Brazil is kind of in a sideways to down pattern, and it's yielding currently around 10% or 11%. This global uranium, it turns out to be one of the best sectors this year. This is one that Dan Niall said at the beginning of the year is going to be one of the best sectors. And the thing behind uranium ETF. Countries are going to be moving towards cleaner energy over time, and so there'll be a more demand for uranium. So this ETF kind of tracks the miners and manufacturers of uranium, and it's overbought right now. So that's not the time to start looking at that one. Okay, I know this is boring, but we only do this once a month. It's worth it. You have to keep track of where the sentiment is for everything you're following. This gives you a little bit of exercise on how to do that. This AbbVie is, let me see. It's like a pretty high yield stock. It's yielding 5% right now, and it's growing at 5%. So it's a total return of like 10%. And so it's kind of in a downtrend here. It's been going down with all the other healthcare stocks this year. So it's been one of the worst performing sectors, healthcare. But I own it because it's a part of my dividend growth portfolio, part of my portfolio. So it's not exciting. They're trying to transition away from Humira, the best-selling drug of all time, to other drugs. So that's going to be kind of awkward. But we'll see how they do there. Abbott Labs, they were in a sideways pattern all year long. Now they started breaking into this lower channel, and I don't know if they're going to go down lower or not. It's not a very exciting stock. I don't know if I would buy it now if I didn't already have it. Alibaba is one of the most boring stocks. It used to be so exciting going up and down a lot, but now it's flatlined. It's going sideways. It isn't really going anywhere, and it's really they're basically dependent on the Chinese government and the rules that are set by the Chinese government, and we don't know what those are, so it's kind of strange. But we're following it anyways. It's just for kicks. Alphabet, we can see that this is one of the best performing stocks this year, like 45%, up 45% this year. It just recently broke out of this uptrend for all year, and it started this other little channel. I don't know if it'll start going back up into that channel again, higher highs, higher lows, but we'll have to see. I think with the end of the year seasonality, it probably could resume the top, this upward channel movement. Philip Morris, they had bad earnings recently, yeah, so they went down like a bunch because of that. But they're still in this little channel here of going like lower highs, lower lows. But with the interest rates stopping going up, it could be all the stocks that are high yielding ones like Philip Morris will be high demand again, because you won't have many options come January or June of next year to get 10%. This is actually yielding 10% now. So this is a stock that I've actually held for a long time. And I'm just let's do that little exercise just for kicks. Philip Morris, Altria. That's Altria. Let's see what it's yielding now. It's yielding 9.64%. Does anyone know how many years it'll take to double your money if it's yielding 9.64%?
Math is hard.
Math is easy. Come on. Okay. Here's.
I'm gonna guess 7. Can I guess 7?
Okay, let's try it. Okay, so Mark said 7. Okay, the rule is 70. The rule is 72. If you divide 72 by the core dividend yield, 9.64. Mark, you were right. 7.4 years it'll take to double your money. Because that's the rule of 72. But I've used that rule. I've held it more than 7 years, so it's more than paid for itself. But with high yielding stocks, you never know if they go out of business. You risk that. But if you buy, that's a good rule to keep in mind. see, hold on for a second. Let's go back to our charts. Okay. So right now it's, an AT&T, Mark, is very similar yielding something, a high yield now. What is it yielding now, Mark?
Oh goodness.
7.6.
7.6. Yeah.
So how long does that take? 72 divided by 7.6. You have to wait 10 years to get your money back on that one.
Actually, it's 7.06. That's the difference.
Oh man, yeah, you're right.
Because it's up today. Everything's up today except for Apple.
Oh yeah. Apple. Let's look at Apple reported earnings last night, and they were basically showing that they had no growth year over year. That means their earnings aren't growing. I'm going to look at that just to see what it looks like on that chart. We like to look at the earnings over the stock price. I guess I might not be able to get in today. Let's see. Okay, I can. So basically, Apple has turned from a 10% to 20% growing company to no growth company. And as a long-term shareholder in this, I'm hoping, see, their current P is 28. I'm hoping that some of their new products or services will kick them into gear where they can make money again, but they're not predicting that. So it's strange that. Okay, let's look at their earnings estimates over. Okay, 16. 6.13 divided by 6.54. That's 6% growth from this year to next year. 6.54 divided by 7.16. 9% growth. Then 14% growth after that. So for a stock that trades at a P of 28, that's only growing 9%, or it's 6%, that is super, super overvalued. But they have consistency in making money, so that's why they're trading at a premium. But this is an example of a stock where one piece of bad news could really hurt the stock and make it go down to what it's growing at. It's growing at 6% right now, which is really, really bad for a stock trading at a very high premium. So let's look at see. That's the case. Philip Morris, Amazon. Okay, Amazon is actually, they had a really good earnings report. They're overbought, and they're right in the middle of their channel. So this is not the time to buy Amazon. Apple, you can see that Apple is actually, it broke out of its uptrend. We mentioned as soon as it broke out of this, this was way back in August, but you can see it's making lower highs, lower lows, and with this bad earnings report, with an earnings report that basically says they're not growing, they could very easily continue this downtrend. So don't be well, they might continue that. So a lot of stocks like Google are starting this to break out of their uptrend like this and to go down. So let's see if any other major tech stocks follow that. Amazon isn't, though. Look, Amazon basically is resuming its uptrend. And AT&T is actually stabilized. It was going down for all last year, and all of a sudden we're starting this sideways pattern. So Bristol-Myers Squibb, let's look at that. We stopped looking at this, as a consideration way back here because of their earnings. They weren't growing anymore, BMY. But it's good to always watch a stock and see if the earnings estimates are changing at all. Earnings. I forgot to look at the PE ratio. Their PE ratio is 12. Okay, so in the earnings, they better be growing their earnings at 12. No, they're not. Look at that. It's so inconsistent. They're not growing at all. That's flat earnings. So that's the reason why I stopped following this as a potential thing to buy. It has a dividend, but look at this. Year over year, it's losing money from this year to next year. Year after that, in 3 years, they're going to be earning less than they are this year. So officially, we're going to take this one off of our watch list because it's a loser stock. Okay. Colgate-Palmolive. It's in a reliable sideways pattern here. And same thing with CSX. They're in a sideways pattern. Another big tech stock, Meta, is in a sideways pattern now. Maybe higher interest and lower interest rates will help all of the tech stocks and give them a higher valuation and allow them to go up. I think that's what's happening in the stock market right now. JP Morgan it was in an uptrend, now it's starting to go down. I don't know how interest rates are going to affect the banks because I don't know anything about that. But you can see Microsoft, another one of the big tech stocks, is going sideways. Pepsi, I think it's still in a sideways pattern here. It's a dividend stock. And same thing with Procter & Gamble, it's in sideways. And Starbucks had a really good earnings report this week, but they're oversold. Surprised. I think they're right here. They broke out of this downtrend, and they'll probably stay in this sideways pattern for the next year or so. Visa is one of the only stocks we're following that's in an uptrend, and it keeps going up. MasterCard has the same pattern. I guess for this environment, they're unaffected by interest rates, inflation, because they're just a toll collector. They just they make more money when the economy's good, and whenever there's high inflation, there's less products being sold, but they're sold at a higher price. So they're pretty much insulated by economic problems, I think. Okay, so Verizon, just like AT&T, I think they're breaking out of this downtrend, and it's starting to go in this little uptrend here. I think these stocks, like Philip Morris that I talked about earlier, that have high dividend, they actually will be in high demand next year because if interest rates go down, then there won't be many options. Let's look at the Verizon just for fun. I wouldn't buy Verizon now if I didn't already hold it because it's okay. We have a PE of 7. A lot of the phone companies have P's of 7 because they're not growing that much. And the dividends doesn't even have a dividend. Hold on, let me look at the dividend of PC. Okay, the dividend is 7.41%, very similar to AT&T. Okay, so I'm thinking a lot of the fixed income or dividend-oriented stocks that are high dividends, they're going to break out their downtrends now and start being doing good. So if you don't have a part of your portfolio that's fixed income yet, this would be a prime time to start dollar costing into higher yielding things. Waste management is pretty much one of the most consistent stocks we're having for going sideways. It's overbought right now. It's not a good idea to buy that one right now. And it's at the top of its channel. Okay, Amgen, it's in an uptrend and it's oversold. So you can see this is an example of a stock it's oversold and it's at the bottom of the channel. I've never bought Amgen. We're just following it just as a random stock. CVS, it was going down in a downtrend for a long time. Now it's just basically going sideways. Their fundamentals aren't that great. I wouldn't be buying that one anytime soon. Let's look at CVS just for fun of a stock not to buy. CVS. Okay, so CVS has a PE of 10. That's a really low PE. Let's see if they're growing at 10%. They are not growing at 10% this year to next year. For the next, okay, so this is interesting. So they're flat earnings for the next 2 years. So if you hold the stock, you're basically going to be going sideways for 2 years. And then you might, after that, from 24 to 25, 8.56 divided by 9. Then you grow 9%. Then you grow 9%. So it's a 0% earning stock from this year to next year. And then you start growing at 9% after that. This CVS company actually owns one of the largest healthcare companies for insurance. So I've never been in that market. I don't understand it well enough, but it doesn't seem very exciting to me. But it's growing at 9% after next year. And if it does, its PE is 10. So it's fairly valued if you think of that way, but it's not exciting for me. All right, let me see. Johnson & Johnson is still in a sideways pattern. It's been like that forever. Walmart, this is another truly reliable growth stocks that we're following, and it's still in an uptrend. I guess if there's going to be a recession at the beginning of this year, like Jeffrey Dunlop says, then people are going to be cutting back and going to Walmart to save some money, and that's going to help them there too. They're overbought, and they're like right in the middle of their channel, so it's not a good time to buy that one. Tractor Supply is in a downtrend. It's oversold, and halfway between bought and sold. That's not a good time to buy that one. And Berkshire Hathaway, it's halfway between overbought and oversold, and it's halfway in the channel, so it's neither a buy nor a sell time. And MasterCard, that's interesting. MasterCard broke out of its long term uptrend. It's kind of down here, like right now. It's oversold. That's interesting. It would break out of that, but let's see if it follows Visa and resumes this uptrend. And eBay it was in a sideways pattern for the longest time, and all of a sudden it's starting this downward pattern. Let's look at eBay as a stock possibly not to buy that's having some problems. I've kind of lost faith in eBay because their growth portfolio their earnings projections aren't so great anymore. It was really good. Okay, they have a PE ratio of 15. Let's look at their earnings. They better be growing at 15. They're not. Definitely not 15%. 4.16 divided by 4.41 is 5%. 4.41 divided by 4.69, 5%. 5%. Okay, 6%. So they're growing at 5%, and they're trading at 15. So that means it's 3 times overvalued. That's the example of a stock that's lost its way. Even though they have consistent earnings, it's not a growth stock anymore. So I've lost interest in this one, but it's good to follow it. All right. So we have Boeing. Boeing is a stock that's they have a monopoly, a duopoly. Only the Airbus and them make large passenger aircraft in the world, but they have a quality control problem. Every half of a year, there's a major problem where they can't produce planes because of a certain problem, and that reduces the amount that they can sell. And there's a constant problem with production and reliability. Let's look at BA as the stock example of a stock. It's inconsistent, the inconsistent earnings that it's most likely because of poor quality assurance maybe, and design and being able to produce things. So their PE ratio is 10. You see, look how inconsistent, look how much red is in this chart. Negative $6 earnings this year, then $3.50, then, but you can't trust this. They could have a negative earnings report because they missed their deliveries or something. So this is an example of a very inconsistent earnings chart with negative numbers that Warren Buffett wouldn't touch this because Warren Buffett likes solid earnings over time without negatives, and they can predict 10 years in advance they're going to still sell X number of planes. But Boeing, you can't do that because you don't know if they're going to screw up the fuselage of their plane and have it recalled or something. So that's why this stock here is kind of unreliable, and it's a stock that Warren Buffett wouldn't buy, I don't think. Okay, and let's look at one more. Tesla is still in an uptrend after a year. It hit, like, it's at a bottom, and it's oversold. So this is the prime stock that, if it resumes its uptrend, that's a long ways to the top of that channel. And NVIDIA, they're going to report their earnings pretty soon. They're in a sideways pattern, just like the other major tech stocks. But if they do good on their earnings report, there's a lot of indications they probably will, and that it'll probably go up. And Nike is in a downtrend. We got a couple more stocks here, and it'll be worth it. Ford, they've lost control of their labor costs with this UAW deal, and they're not going to be profitable. And it's just a bad. Let's look at this stock as a example of stock to avoid. Their earnings aren't going to be as good because they have to reduce the price of their cars to match Tesla, and they have more costs for their cars based on this UAW deal with labor. So let's look at this. That's zero growth for the next couple of years. Look how bad that is. The only thing they can do is give a dividend to people. So if you want a dividend, you're probably going to get it, but it's not worth holding for any kind of growth. It's like zero growth. That's pretty scary, if you ask me. Okay, well, I think I've exceeded my time. Thanks, everybody, for attending. I hope you enjoyed that. I hope you have a good weekend.
Thanks, Greg.
All right, see you next time.